If you're a founder, entrepreneur, or an investor, the recent changes to qualified small business stock could save you millions in taxes. Listen up to learn how. The One Big Beautiful Act signed on July 4th, 2025 has significantly expanded tax benefits for qualified small business stock. And today, I'm going to break down exactly what it means for you as an investor or a founder. But before we dive in, make sure you like and subscribe so that way you don't miss out on any of our tax and business strategy videos that can help you achieve your financial goals. Let's go. First, what is qualified small business stock and why should you care? Qualified small business stock is a powerful tax incentive available to entrepreneurs and investors in early stage companies. Here's why it matters. When you sell qualified small business stock after holding it for the required period, you can exclude a significant portion of your capital gains from federal taxes. This isn't a small benefit. We're talking about potentially millions of dollars in tax savings. Now, not every business qualifies, so it's important to understand the details that we go through later on in this video. So what are the qualified small business stock tax benefits you should know? If you're issuing or acquiring stock after July 4th, 2025, here are 3 potential benefits that could save you millions of dollars in taxes. If you issued or acquired stock before this date, you can still benefit, just under slightly different terms. First, there's a tiered tax exclusion based on your holding period. The longer you hold qualified small business stock, the more benefits you get. If you hold between 3 to 4 years, 50% of your gain is tax-free. If you hold between 4 and 5 years, 75% of your gain is tax-free. And then the best, if you hold for 5 years or more, up to 100% of your gain is tax-free. Think of it like a reward for patient investors and founders. This is a much better benefit than it was just before the bill was passed. Now, how much of your gain can be excluded? For each qualified company you invest in, you can exclude up to $15 million in gains from federal taxes. This limit will grow with inflation starting in 2027, which makes the benefit even greater as time goes on. Also, the new bill expanded the company eligibility. Previously, only companies with up to $50 million in assets qualified. Now, companies with up to $75 million in assets can qualify for QSBS treatment. This makes the benefit available to more businesses than ever before. This threshold also increases with inflation starting in 2027. Now, who can benefit from QSBS? QSBS treatment is available to founders and early employees who receive stock as compensation, angel investors, venture capital investors, that's the individuals, not the funds themselves, and even family members who receive qualified stock as gifts. But remember, the stock must be acquired at original issuance for money or property or as compensation. Secondary purchases do not qualify. Before you get too excited, let's clarify which industries qualify for QSBS. First, the businesses that qualify. Technology companies, manufacturing businesses, retail businesses, and wholesale businesses all qualify. On the other hand, there's plenty of businesses that unfortunately are excluded. These companies include those businesses that provide professional services such as law firms, accounting firms, healthcare practices, banking, leasing, farming, mineral extraction, hotels, and restaurant services. Now let me show you how these rules apply with a powerful example. Imagine you're a founder of a qualifying business who sells a company for $20 million after receiving stock at the formation. Here's how the tax treatment would differ. Without QSBS treatment, you'll be subject to regular capital gains. Your $20 million will be multiplied by 23.8%. That's 20% for capital gains plus 3.8% for net investment income tax. That equals $4.76 million in taxes. Now let's look at it under QSBS with a 4-year hold. Under a 4-year hold, you'll get 75% or $15 million of the $20 million gain excluded from tax. That means $11.25 million of your gain will be excluded. Your remaining $8.75 million of gain will be subject to the 23.8% tax we just went through, for a total of $2.08 million in taxes. If you compare the difference, that's total tax savings of $2.68 million. And if you held for 5 years or more, you could exclude the full $15 million of gain, saving even more. So how should you plan to take advantage of this if you're a founder? First, understand that entity selection matters. If you're starting a new business and want to qualify for QSBS, understand that only C corporations qualify. While LLCs and S Corps provide pass-through benefits, they don't qualify for QSBS treatment. Next, make sure you track your holding period. Document when you acquired your shares and keep detailed records. The new tiered structure makes this even more important. Lastly, consider a multi-issuer strategy. If your business model allows it, consider creating multiple C corporations for different business lines or geographic regions. Each C corporation can potentially qualify for its own $15 million exclusion. Now, before we wrap up, let me warn you about some common pitfalls. First is issuing or acquiring stock after the company has exceeded the asset threshold. Make sure you're monitoring your company's assets carefully. Remember, if they exceed $75 million before you issue the stock, you'll lose QSBS eligibility. Next, careful with redemptions. Certain stock redemptions around the time of when you issue stock can disqualify your QSBS status. And lastly, if you've acquired stock at different times, understand that each batch has its own holding period and potentially different QSBS rules. Updates to QSBS represent a significant opportunity for investors and founders. With a shorter holding period, higher exclusion amount, and increased business size threshold, now may be the perfect time to evaluate your business structure and potential investment strategy. Remember, tax planning should start early, even potentially before you form your company. If you found this information helpful, please hit that like button and make sure to subscribe to our channel for more videos like this. Also, drop a comment below if you have questions about how the new QSBS rules might apply to your situation. Thanks for watching and see you in the next video.